plan. The market seemed to like that. Bonds actually caught a bid. So why the sharp reversal today, in your view?
Well, is it really a rethink, or is it just simply ongoing uncertainty surrounding the numerous issues we're thinking about? I think the Fed's caught in what I'd call, and I'm thinking of the Seinfeld episodes I've been watching, the opposite episode, the George Costanza rate hike cycle. The Fed will be doing the opposite this year of what it did during the last big inflation battle of 1994, when the 10-year yield shot up to over 8%. Back then, Greenspan was known for so-called gradualism. Greenspan gradualism started off with small moves, 325 basis point moves, 250 basis point moves in May and August of that year. Then, wham, 75 basis point move. You'd think that would hurt the markets. Instead, it ignited a big rally, and markets never looked back, never started thinking about those higher yields until recently. So here you see the Fed acting aggressively. People yesterday said the Fed wasn't aggressive, but it has an aggressive plan, and it's told us it will move expeditiously, etc., and it's highly attentive to inflation. So investors should trust in the Fed. What you should be doing is listening to the adage, don't fight the Fed. And today that means trusting in the institution to battle the inflation level down, which will ultimately be good for investors.
Down 1,300 points now on the Dow. It's just getting worse, Tony, down 6% on the NASDAQ. What do these rising rates do to the economy? If we continue to see yields go up, we continue to see the Fed have to move. I mean, we've already seen mortgage rates spike. What is PIMCO's view on how much economic damage will be done as a result of what's happening with rates?
Well, we're sanguine about the outlook for the next year, and we put odds similar to what the New York Fed has on its website regarding the yield curve, odds of lower than 10% for recession in the next year. Looking 18 to 24 months out, that figure rises, call it 30% or so, because we are, in fact, in the midst of a fast-moving cycle with the jobless rate falling and likely continue to fall. But the good news in terms of the slowing of the economy, if it occurs, it'll correct the imbalances that are causing problems. Chair Powell mentioned yesterday the numbers of job openings, around 11.5 million. The numbers of unemployed is half that. And so if there's a reduction in demand that reduces labor demand, that can be a good thing. Final note real quick, the burden is, there's more burden sharing in the markets. It was all about the bond market weakening from 2 to 3% in the 10-year. Now it's spreading around to other areas, which means the Fed's handiwork can work, and it can be successful in getting to that so-called an elusive soft landing.
So when does inflation peak, in your view? Because that seems to be the key to all of this.
A tightening of financial conditions almost certainly will have some impact on the economy, and we think ultimately brings the economic growth closer to growth potential, which is around 2% next year. And typically when that happens, the inflation rate starts to moderate. There are factors that could lift it over time. You've heard about reshoring and things of that sort, and even climate change and investments there, and of course the geopolitical story. So that could keep it somewhat higher than we saw in the 2010s, which is probably the wrong analog for the 2020s in terms of thinking about inflation. But there's deflation in financial assets now. It almost certainly has some impact on demand later. And there is a long leg, and the Fed is like walking a dog with a long leash when it conducts policy. But it looks like it's moving in the right direction, but it's going to take a bit of time. But the peak should be around now, call it by the summer, the worst case.
What does it all mean, Tony, for the dollar, which is now up 8% year to date? It's making another big move higher, which also tightens financial conditions, right? And hurts the economy through exports and through corporate earnings. Didn't help overnight to have the Bank of England come out and warn about the economy as they're raising interest rates. That currency is getting slammed. But overall, strong dollar, where does that go, and how do we feel it?
Well, the big story, and it fits with this burden-sharing idea I mentioned, that with the Fed's, the transmission of monetary policy occurring through many channels, that includes the dollar now. It had not until even a few weeks ago. The dollar seems stronger, looking at it dollar yen, dollar euro, but on a trade-weighted basis, which is what matters in terms of affecting the economy, it had barely moved, according to the Fed's index, because of strength in the Canadian dollar, which is our biggest trading partner in terms of destination of exports. So now we see a few percent move in recent days, and I should say the couple of weeks, in the dollar that could begin to eat away at economic growth and then again handle some of the imbalance.
Right.
And so that could be a good news story in this burden sharing, more straws on other camels' backs idea.
Finally, we get a jobs report tomorrow. Tony, what do you expect, especially coming off of a day like today?
Well, jobless claims tend to be one of the best predictors of that, and there still is a recovery theme which we are strong believers in, which is why we're investors in recovery themes such as in the lodging and airlines industries. You know from your own personal experience, and we all do have these stories of seeing a change in conditions. I know here in the New York City subways, not as crowded as they used to be, but picking up a bit. Restaurants, concerts, airplanes, they were fuller last week when I was on them. And so that should keep demand strong. But we should look for moderation as that recovery theme plays out over the summer months.
Tony Crescenzi. Tony, thank you very much from
Thanks,
PIMCO
as
today.
always, Sarah.
Just want